Good morning, everyone. Let's start off the session with your very own Mayank Kaushik. Mayank, over to you.
So good morning, everyone. As you all know, my name is Mayank Kaushik. So today we are here for a client advisor workflow workshop. So firstly, on the behalf of Trustline employees, I would like to thank CMT Association and a special thanks to Mr. Akshay, Kaiza, Joel, Vishal Mehta for arranging this workshop for Trustline. So guys, without wasting any time, I would like to hand over the stage to Joel for taking this further. Joel, can we start now?
Thank you so much, Mayank. And thank you to everyone who's joined the session for Trustline Securities. So what I'll do is I'll take a few minutes before I hand the stage over to Akshay to actually conduct the meat of the session, just to talk about why we are doing the session and who the CMT Association is. So the CMT Association is the world's top credentialing body and advocacy body for technical analysis. So when people who do not know about the CMT Association ask me कि ये है क्या, I usually say, have you heard of the CFA Institute? The CFA Institute and the CMT Association are siblings that were born from the same parent, which is the New York Society of Securities Analysts. And this happened in the 1960s and 70s. And so, since then, the CMT Association has been a place where technical analysts can get together and talk about the latest enhancements and advancements in the field of technicals, and how does technical analysis combine with other forms of analysis to make investment much more risk-free and much more accessible to professionals primarily. And so the client advisor workshop that we are running here in India is kind of born from that original philosophy. Everyone on this call is not a retail market participant, but a professional working to help other market participants. And so the idea is, as professionals, how can you understand and learn the basics of technical analysis and yet not be overwhelmed by getting into the depths of it? So once you can start and find a few skills that you can use yourself, you can actually then start taking that forward and making it something that helps you in your career. So that is the idea behind this. So the CMT Association, like I said, was established in 1973, was when it was incorporated, and it kind of grew organically on its own as an association of members where more and more technical analysts kept meeting and talking to each other. After a point, about 10 or 15 years, they felt that इतने ज़्यादा लोग हो गए कि we should have a certain benchmark of excellence only beyond which you can be a member of the association. That benchmark became the CMT program. So you will see a lot of the speakers and a lot of senior market professionals who have the letter CMT against their names. That designation came after the setting up of the CMT program. This was in the early 80s. And once the CMT program got set up, it grew around the world, and the CMT Association memberships kept growing till around the last decade. There are about 135 countries where CMT charter holders are present, and there are chapters in more than 46 countries. And what we saw is that what the association noticed is that in India, especially, there was a very interesting, strong growth story. Around 2005-6 was when market participants in India first discovered that there is such a thing as CMT, and that represents the highest standard of technical analysis. And we started getting our first charter holders who went through the program around that time. In the past 15 years, the community has grown so much that last year, India had more candidates for the CMT program than the US as well. So that has been a tremendous growth story. So to kind of back up and support that growth, the CMT Association set up its first office in India. And this is its first office outside New York. And so I quite enjoy telling everyone that I'm the first employee of the CMT Association outside New York. And what has also happened is we set up this office in December 2018. And since then, we have seen a lot of interest and a lot of growth, not just in the size of our community here in India, but in technical analysis in general. And so as a result, the India office, in fact, as of today, let me put it this way: the new entity has been incorporated day before yesterday in the evening, and from now on, this has been the CMT Association's Asia Pacific office is now based in India, and you are one of the first people we are interacting with as the Asia Pacific office of the CMT Association. So it is actually proof that there is a lot of growth of interest and awareness of technical analysis. But one of the things that we are very keen to do is to not make technical analysis, this discipline or the tools of technical analysis, available only to people who are directly facing the markets. People like research analysts, like traders, dealers, fund managers, treasury managers, people who directly engage with the markets. But there is a lot of value in the tools that technical analysis brings for market professionals in the front office in general. So not just if you are facing the markets, but also if you're facing clients and you have to talk to your clients and engage with them and advise them about what is going on in the markets, understanding technical analysis gives you very easy tools. Because while there is a lot of data about the company's balance sheets, you have other fundamental data about a company and economic data, all this data might not be very easily accessible. But price data is available everywhere. Volume data is available very easily on free platforms as well. So, as market professionals who are engaging with clients and talking to them about the markets, advising them on what positions they can take, how they can, more importantly, manage their risk, it becomes very important for you to have some tools that you can start using. So, this session was designed for client advisors, investment advisors, and client facing roles where you have to understand and talk about the markets in an educated way. Now, the discipline of technical analysis is really vast. And when I introduce Akshay to you, you will understand the kind of study it has taken for him to get to where he is. But so we don't want to make it in depth about technical analysis, but what are the key elements in your job as client advisors that technical analysis can help you with? So, with that, we identified a few key areas. One, how to look at a universe of stocks and come up with a few ideas that you can trade. How, when you look at those few ideas, can you decide which of these is an entry opportunity right now so that you can talk to your clients about where are the new trading opportunities? Once you do that, as you are suggesting the entry to your trade, what is the target you want to propose? What is the stop loss that you want to set? That also comes through a very logical basis of calculations that technical analysis can help you with. Once you decide your target and your stop loss, you enter the trade. How do you manage your risk and your position within the trade as well? Because that also makes a very big difference to the kind of output that you can achieve as a trader. Like George Soros says, it is not so important that you are right most of the time, but that when you are right, you make money, and when you make more money, and when you are wrong, you lose less money. This is not the exact quote, this is kind of, I'm paraphrasing. But the key is, how do you manage your positions? How do you manage your money? How do you help your clients do this so that they can also trust you as an advisor, knowing that you have not only their best interests at heart, but you are developing the skills that will help them to perform the best in their job, right? In their money management, which is your job, right? So with that in mind, let me introduce our speaker for the day, Akshay Chinchalkar. Akshay will be taking you over the next 5 weekends through these 5 sessions to help you understand this workflow that I mentioned, right? Now, Akshay, in terms of introduction, he and I have, funnily enough, what we found out much later is that he and I went to the same school together, and we were in the same batch as well. But this was from class 1 to class 4, and we never really met. But we ended up meeting at Bloomberg. Akshay completes, in the next 3 months, Akshay will complete about 12 years having worked at Bloomberg. He and I worked together between 2010 and 2017. Akshay is known across Asia as one of Bloomberg's foremost technical analysts and has a depth of knowledge that comes not only from his MBA and his postgraduate degree from the London School of Economics, and then having done the CMT Charter, but he's currently also doing his CFA program and is also doing his quantitative finance program from Quantensity as well, the EPAC program. So Akshay is one of these resources who is a fount of knowledge and has been working in the industry for more than 17, 18 years now. So we're very happy to have Akshay on board as a panelist. And what Akshay will be, right now, Akshay works with Bloomberg as a senior editor for the cross asset desk. And in this role, Akshay is able to get a view of all the markets and across asset classes, across geographies, across time zones and time frames as well. So it's a very good opportunity for us to kind of learn from Akshay and understand his thoughts about this workflow. So please understand once again, we will not try to cover the entire depth and breadth of technical analysis. We will try to keep it very focused to these 4 or 5 key elements of the client advisor's workflow. And I strongly, strongly encourage you, please practice every skill. We will have these sessions every Friday from every Saturday, sorry, from 10:30 to 11:30 in the morning. Akshay's instructions part will be very short, but I definitely encourage you to ask as many questions as you can. To ask questions in the chat window that you have, you just need to ensure that send questions to staff is selected, and then you can type your questions. The questions will become visible to myself or Kaizad, and we will direct them to Akshay as the session goes along. But far more important than that also is practicing the skill that you learn in the week between the session that you do and the next session, so that when the next session happens, each session will build on what you learned in the previous session. So this practice will actually help you to put it in, bring the skill into your job, right? So on that note, I really encourage you to participate as much as you can. Please bring this enthusiasm with which you have joined the program to every session that you learn from. And also, the one last thing I want to remind you is the CMT Association has a Discord platform as well. Now, Discord is a communication and networking platform that we have set up, and you can access that and you can participate in the discussions that CMT charter holders and other members are having on the markets on a daily basis. So, in order to access the Discord platform, you can go to go.cmtassociation.org/discord. Right? I'll repeat: go.cmtassociation.org/discord. DISCORD. Right? So with that, on that note, I will thank you all very much, and I will invite Akshay to take over the session and have a great learning time.
Joel,
thank you, Joel.
Yes, Maya.
Joel, are we recording this session?
Yes, it is being recorded right now.
Okay, thank you. Akshay, please continue.
Thank you, Joel, for that wonderful 2 cents on the CMT Association, the kind of efforts we're putting in, and it's very encouraging for all of us to see that the number of candidates out of the Indian subcontinent now exceeds the number of candidates taking the CMT exam out of the US, which is tremendous. So Mayank, to you, thank you so much for bringing this big audience into the session. I hope everyone learns a couple of things that they can take away and start using in the way they trade and operate and talk to their clients. So having said that, I'm hoping that you can see my my deck. The first slide, which says sell side client advisor workflow. Mayank, if you give me a thumbs up, we can proceed.
Yeah.
Yes, actually.
Great. So thank you, Mayank. So as Joel very clearly laid out, this is going to be a 5 session series, and this is really what the progression is going to look like. For today, we're going to focus on the item at the top left box. The agenda for today is screening, and how you can use some readily available platforms slash websites.
To the next slide, huh?
Oh, is it?
Yeah, we're still seeing your cover slide, the first slide.
Let me unshare. And are you seeing it now?
Yes, we can. All good now.
Thank you, Joel, for letting me know. So here is how the progression of the next 5 weekends is going to happen. What we're going to focus on today is screening. And there are many platforms and websites which you can immediately start using to build screeners like the one that I'm going to show you. Screening is a very, very important process. And the answer to why is because, there are so many indices. There are so many different time frames. How do I know, where the largest opportunities to profit from are at any point in time? So screening helps you condense the available universe, the available data set to a few stocks, which you can then focus on an individual basis to kind of see whether the opportunity that you're looking for has really manifested itself on that chart. So everything really starts from screening, right? So that's going to be the overriding focus of today. And then in the coming weekend, we will talk about some important trading metrics, such as defining risk reward parameters, and something that is very, very critical but seldom used, which is position sizing. I think position sizing is one of the most important aspects of trading / investing, because it ensures that when you are wrong in a big way, you don't lose your entire capital. So if you can size your positions in the right way, then obviously it becomes a lot easier to manage that position, even when things don't turn out the way you expected them to. So that is going to be the focus of the next session. Session number 3, we will talk about backtesting and quantifying certain metrics which investors of today are starting to care about. Think about it. We are no longer living in a world where a client calls you and you tell him, oh, the RSI for this stock is below 30. It's oversold, so it's a good time to buy it. If we were to go, let's say, a decade ago, people would find that very valuable information. The investor of today will think of that as incomplete information. That's only 30% of what he cares about. What he really cares about is, how has this strategy worked in the past? Does it really have alpha in terms of forward returns? Now, if I send him this opportunity, if I tell him that, oh, look at this particular stock, its RSI has been below 30, and then I also tell him that in the last 10 years, this has happened 50 times, and in 45 out of 50 occasions, this particular security was higher by an average of 5% over the next 1 month. That is extremely important information that the investor of today is starting to seek. And why is he doing that? Because he himself has become a lot smarter, right? He has access to information, he has access to platforms, he has access to news, he has access to anything under the sun. And that has made him question the idea generation process even more. He's looking for hardcore metrics in terms of quantifying what his advisor is telling him. So as clients have started becoming smarter and smarter, the onus is on us as advisors to become smarter ourselves, which is why things like backtesting and so on and so forth are becoming even more significant today. Session number 4, we will talk about money management and managing the position with trailing stop losses and other methods. And finally, we will conclude the workshop by putting the ball in your court, and you will talk to me about what you've learned and kind of convincing me that you've understood everything that we've covered over that 5-weekend duration. So I hope that kind of sets the tone. And now let us go into the agenda for today in a little more detail. So as is obvious, you've been in this business longer than I have. There are thousands, okay, and that's still a very small number. I think there are thousands of screeners that you can build and immediately start using. These screeners can be as simple or as complicated as you want them to be. But in terms of availability of screeners, I mean, the sky's the limit. Now, there are different kinds of screeners that you can build and use. Some of them can be based on price, for people who believe in candlesticks. You'll obviously focus on price. Some people care about volume, and understandably so, because volume is a very, very important part of what we do in our day jobs. Some people have a significant focus on technical indicators and technical signals. What is the RSI up to? What are Bollinger Bands up to? What is the MACD up to? What are moving averages up to? And so on. Now, with options trading exploding in India and in other parts of the world, volatility is becoming such an important discussion point. So a lot of traders are now starting to pay more attention to volatility, particularly options traders. And again, I mean, that's something that you will be able to relate to. And finally, sentiment. I mean, there are these contrarian traders who've made a living out of buying when nobody wants to buy and selling when nobody wants to sell, because they care about sentiment. If sentiment is extremely negative, and they track things such as social media, if sentiment is extremely negative, it's probably a good time to start buying. If sentiment is extremely positive and nobody thinks anything is going to go wrong, it's probably a good idea to sell into the market. There are different kinds of mandates that people have, and screening can basically help with all of them, which is why it's a very, very important piece of the puzzle. Now, although whatever I'm going to showcase to you today is coming off of a Bloomberg terminal, because I have access to Bloomberg, and for me, I understand the Bloomberg terminal really well, so I can build screeners, I can build custom studies, I can build alerts, everything at the click of a button. So my examples will focus entirely on Bloomberg, but I have laid out in box number 3 all of those different platforms / websites available to one and all, which can also help you build screeners such as the one that I'm going to demonstrate. Okay. Now, and like Joel said, right? Sorry, I lost my audio for a bit. Are you guys still able to hear me?
Yes, actually.
Yeah.
Okay, great. So from experience, right, I've been doing this for almost 17, 18 years. I've met, almost every player type, front office trader at a buy side, analyst at the sell side, front office traders at, family offices, alternative investment funds. So I've really met the whole gamut of, financial market participants. And whenever I talk to them about ideation, what I realize is most of these guys are very familiar with the standard types of screeners, such as screeners based on moving averages, screeners based on concepts such as, again, moving average concepts such as golden cross, death cross. They know about Bollinger bands, they know about RSI 70-30, overbought, oversold, so on. I mean, most people know about these things. But the focus of this presentation is going to be, two things. One is I'm not going to use an indicator which you've never heard of before. I'm going to use an indicator which you have heard of almost every single day of your lives, whether you're a trader, analyst, technician, or someone doing hardcore quants. The indicator that I'm going to focus on today, I'm 100% sure each and every one of you would have at least heard about it. So, what I've realized from experience is that it's okay to be using popular indicators which everyone has heard about, but you should know the more advanced aspects of how professional traders actually use that indicator, rather than using something like 70 means oversold on RSI and 30 means 70 means overbought on the RSI and 30 means oversold. If something is as simple as that and everybody knows about it, it is very rare that you will generate a huge amount of alpha using something as basic as that. Not to say that 70-30, not to say that overbought, oversold does not matter. It does matter, and it matters a lot. But is that 70-30 the right threshold, to use? That is the question that you should ask yourself. So it is not about, the RSIs and the Bollinger bands and the MACDs of the world don't make money because everybody uses them. It is about how much you really know about them to kind of expect them to make money for you. So that is what we'll focus on. We're not going to do, anything that's out of the world. The other thing about screening that I want to kind of make very clear is that a robust screening mechanism has to be able to screen multiple time frames. You should be able to screen for a particular setup on intraday charts and also on historical charts such as daily and longer term charts such as weekly and monthly. So a good screener should offer multi-time frame support. And the final point, I cannot see this as much as I already have in another session that I did just before I jumped into yours. Coding 10 years ago was something that only hardcore programmers did. So they would program something that the front office wanted them to program. They would present the code, and then the front office would be able to get ideas off of that code, which they would then relay to their clients. And depending on that, clients chose to either go long or short or do nothing. Now coding is becoming mainstream. So regardless of what you do in your day job, it is absolutely essential that each of you has at least basic coding language. And I can tell you, I'm still learning Python, but I've probably gone to the deep end of Python now. When I began my journey about a year ago, about 10 months ago, I knew nothing about Python. I knew a few things about coding because on Bloomberg, I code on my own. But Python was a very different language. The good thing about Python is you're really coding in English. You don't have to have a hardcore programming background to be able to write your first Python program. And the sheer number of libraries available within Python has made it so simple that you can go from being, knowing nothing about coding to become a Python to becoming a Python expert in like 6 months. I can tell you this from my own experience. So please don't think that the world of tomorrow will look like the world of yesterday, where only programmers will code? No, the change is for real. Anyone who wants to, recommend ideas to clients or generate ideas for his own proprietary trades will have to know basic coding at some level. This change is for real. We cannot escape it. So I would really recommend that for the ones who are, who have a bit of mathematical bent of mind, please start exploring the world of coding, and you'll be amazed by what you're able to achieve. Excellent. So that is going to be the broad, focus for today. What we've summarized on the screen. Now, I said I wasn't going to use any indicator that you haven't heard of to kind of walk you through what I have for you today. I'm going to use this very, very popular indicator, which you have at least heard of. Some of you may have used it. Some of you may be using it on a daily basis. Some of you not so much, but you've definitely heard of this. We are going to focus on Bollinger Bands. Now, before I introduce the setup that I will use in my screener, let me spend 5 minutes talking about Bollinger Bands and its introductory aspects. So what are Bollinger Bands? They are studies that have been built, rather it's a single study. It's a study that was built to visually inspect volatility in the underlying security. So whenever you talk about Bollinger Band, you're talking about 3 lines. The first line is a 20-period simple moving average. So John Bollinger, when he discovered and created Bollinger Bands, he said, the 20-day moving average, in my experience, has worked really well. And he'd done a lot of, back testing. We didn't have the, supercomputers of today to kind of churn out back tests at the rate at which, we're doing it today. But you had, other mechanisms, slower mechanisms, which allowed him to back test. And he realized that the 20-period simple moving average works the best. So that's the first of 3 lines. The second line is the upper line, otherwise known as the upper band, which is 2 standard deviations above the 20-period simple moving average. And then you have the lower band, which is also known as the lower line, popularly known as the lower band, which is 2 standard deviations below the 20-day moving average. Now, I said Bollinger Bands were built to visually inspect the volatility in the underlying security. So the one thing that we know about volatility is that volatility is very cyclical, which means if you have been experiencing high volatility for a long time, soon volatility is going to settle down. And similarly, if you have been experiencing low volatility for a long duration of time, volatility is going to expand. And that's exactly what Bollinger Bands are trying to capture. When the bands expand, it means volatility is rising. When the bands contract and when they squeeze the price, it means volatility is falling. But because volatility is cyclical, the current state of volatility will tell you about what can be expected in terms of volatility in the future. Now, for the ones who are very familiar with the world of Bollinger Bands, you will also, I would be surprised if you've heard of some of these setups, so the volatility squeeze, M tops and W bottoms, very, very powerful patterns, selling at the upper band, buying at the lower band. This is what people typically do. But the setup that I'm going to focus on today, despite using Bollinger Bands, is something that I'm pretty sure the overwhelming majority of you may not have heard of. And it comes from this library of less popular, setups within the world of Bollinger Bands, but very, very powerful at the same time. So you have things such as the alternate M tops and W bottoms, volatility divergences. You may have heard of price divergences. There is this concept called volatility divergence, which is something that options traders use a lot. And then you have something called the outside-inside pattern. There's another thing called the Bollinger Band walk. So there are many patterns. This is not the complete list, but we are going to focus on one of these less known but equally powerful patterns called the outside-inside. Okay, so let's go into that. Now, what I'm going to discuss is both versions: the long version where you go long, and the short version where you go short. So I'll start from the left. Think of the green line as the lower Bollinger Band. And because the lower Bollinger Band is falling, it's going from highs at the top left to lows at the bottom right. It means that the market has also been falling. So there is a established downtrend in the markets. And then you are looking at the chart and you realize there are 2 consecutive candles or bars with certain characteristics that appear on the chart. So what are those characteristics? Now here, what I've got is 2 bars. You can use candles as well. I prefer bars generally. What I've got here is I've got two back-to-back bars. Let's assume that these are daily bars. So this is the daily chart that we're looking at. Can be any security, it doesn't matter. If I look at the first bar, I can see that the close is below the lower band. And here, for the sake of this setup, which is called the Bollinger outside inside, I don't care about the high, I don't care about the low, I only care about the close, I don't care about the open either. Which is why I don't have the horizontal tick on the left, which is the open. I don't need it. The horizontal tick on the right is always the close. So I'm going to go back one day prior and I'm going to say, oh, I look at the close here and it's pretty obvious that the close is below the lower band. On the next day, what happens is the exact opposite. The close is above the lower band. So what we've got here is a Bollinger band outside, inside signal. Outside relative to the lower band, one day prior. Inside relative to the lower band on the current bar. So that's what this bit of text at the bottom says. Consecutive bars, that is a rule, they have to be consecutive. The first close for a buy signal has to be below the lower band, and the second close has to be above the lower band. They have to be back to back, consecutive. What I've got on the right is just the opposite. For a short signal, upper band is going up, which means the previous trend is very clearly up. I've got a close outside the upper band on the day prior, and I've got a close inside the upper band on the next day. So again, consecutive bars, outside and inside relative to the upper band this time, not relative to the lower band. Why? Because we're looking at a sell signal here. This was a buy signal. Now, if you look at this, right, which is why I told you when I kind of introduced the different platforms / websites that you can build this setup on, this is a very, very plain vanilla setup. All you need is the close today and the lower band value for today. And then you need the close yesterday and the lower band value for yesterday. Similarly, for a short signal, you need the close today and the upper band value for today. And you also need the close on the prior day and the upper band value from one day ago. So the construction, writing the code is very, very simple. It's something that any of those websites can help you. Now, like I said, I'm using Bloomberg screens. I've got two screenshots here. I'll start with the one at the top left. This is where I have told Bloomberg that I want to identify, long and short setups. Don't worry about, what this means, but I'll quickly explain the numbers. So you can see there is something there which is called BB outside inside, and then within brackets, I've got three sets of numbers. So 20, 2, and 14. So what is 20? 20 is just the period for the calculation of the central line, which is the moving average. 2 is just the standard deviation factors. And 14, I haven't spoken about this particular indicator, from a Bollinger Bands angle, but that 14 refers to RSI. And why am I using the RSI? Let me give you a background to that. So just going to go back one slide. Now, if I look at the long signal, I said I want to identify a long entry which has satisfied these conditions, ideally at the bottom of the existing downtrend. Now, how do I tell the system that there has to be a downtrend in place? For that, I'm using the RSI. If I want to go long, I don't want to go long at the highs of the market. I want to go long at the lows. If I want to go long at the lows, I'm pretty sure the RSI is going to be at a lower value, which is why I've used the RSI as an additional input to differentiate between what is a long signal versus what is a short signal. And then I simply say, look, if you spot a long condition, give it a green icon and place it below the candle, so it looks like a long entry. And if you see a short signal, place it above the candle, and make sure it's red, so it becomes easier to understand. That's the short entry. So this is where, that's the first screenshot. This is where I simply define my long and short rules. And then what I do is, for the sake of this example, I have used the NSE 100 as an example, as my data set, and I'm running my screener. What I'm looking at is the daily charts of each of the members within the NSE 100. And when the screening process is complete, it's going to show me a dashboard such as this. So let me spend 2 minutes on this dashboard. Oops. Excuse me. So back in the dashboard, the way to read it is from the right to the left. So if you look at the column headers, you will see certain numbers. Those numbers are dates. So you can see I begin from 27th May 2021 and I go all the way to 25th June 2021. And if you look at the column headers, you will see that the numbers are not in succession. They're not consecutive. Why? Because we're only interested in trading days rather than calendar days. So I can tell you 27th and 28th were trading days. 29th and 30th were the weekend, which is why you've got that gap. And what I then have is I got a list of the NSE 100 stocks with at least one signal in the last 30 calendar days. So, and you can see there are only two kinds of icons. Green means that on that day, on the daily chart, there was a Bollinger outside inside long signal. So if you look at the 21st of June, on the daily charts of Adani Green and Adani, I don't know what T means, I'm not too sure. There were actually the Bollinger Band outside inside long signal. How do I know it was long? Well, the color is green, that means long, if you look at the rules here. And as of yesterday, which is the 25th of June, in the entire NSE 100 universe, there was only one stock with a Bollinger Band outside inside signal. That stock was TCS, and the signal type was a short because the icon is red. We don't have to worry about the last three columns here with a lot of numbers that we will cover in subsequent sessions. So, this dashboard simply tells me where, as of today's close, has either a long or a short signal occurred. So it becomes easy to kind of look at one single dashboard and make sense of which stocks to focus on. Please don't, miss the last bit here where I say that this type of screener, because it's a very, very plain vanilla signal, this type of screener can be easily built using TradingView or ChartIn. So I really strongly suggest that you, go to those websites, and there are YouTube videos that will tell you how to build screeners. So please look at those videos as well. It's a very, very simple process. Superb. So now what I've done is I have. This is Mahindra and Mahindra for the last 1 year. These are daily candles. I have drawn some vertical lines, and each vertical line represents a Bollinger Band outside inside signal, either a long signal, which you can see below the candles, or a short signal, which you can see above the candles. So if we start from the bottom left, you will see that there was a Bollinger Band outside inside signal that occurred there. Let me give you a bit of background. I said the prior trend is very important. So I can see that over the last 4 sessions, there are 2 very large bearish candles. So which means the market has really fallen vertically. Which means there is some short-term panic. Nobody wants to buy, and then I get a buy signal. Now, let me go a little deeper into these candles. So you can see this candle is a bearish candle. The close is below the green line, which is the lower band. And the very next candle changes color. It doesn't have to, but in this case, it's changed color from red to blue. But the more important thing is the close is above the lower band. So is this a Bollinger Band outside inside signal? Yes, which is why you've got the green icon. Second part, will I actually go long on this signal? Answer is yes. Here is a short signal. Will I go short? No. Here is a short signal. Will I go short? No. Here is a long signal. Will I go long? Yes. Here is a short. Will I take it? No. Here is another short. Will I take it? Yes. Why no? Why yes? You will learn in the next section. Here is another short signal. Here, tag to this red candle. Will I go short? No. Good. I didn't go short because the market gapped up on the next day. And then it generated another short signal. Will I take it? Depends. Again, you will know why in the next section. I got a long signal here. Will I take it? No. Another long signal? No. Another long signal? No. Good. I took neither of these long signals, and good for me because the market kept falling. There was another long signal here. Will I take it? No. There has been another long signal here. Will I take it? Yes. So again, let me repeat. Why and how am I deciding which signals to take? Signals will appear frequently, but I have to decide which signals I'm going to take and which signals I'm going to ignore. That will be known to you in the next session. Just hold on to your horses. Now, this is the last slide. Very, very important slide. I said investors of today are becoming very smart. And therefore, it's very important for you as an advisor to know, whether a certain strategy you are recommending to them has merit in being recommended. So what I've done here, and let's spend 5 minutes on this because this is a very important slide. What I can see here is that I'm assuming I'm a plain vanilla old school investor. I'm also assuming that I generally go long and remain long over the long term. I don't, trade in and out on a regular basis. Very old school. I believe in passive investments. I'm more interested in mutual funds, ETFs, blah, blah, blah. No active management. So what I'm doing here is, let's keep the short signal aside for a moment. Let's focus only on the long signal. Remember what happens in a long signal. Prior day, the close has to be under the lower band. On the current bar, the close has to be above the upper band. If these two candles and their conditions are met, I will go long. Now, I ran some analysis on the Nifty, and I said I want to run an analysis over the last 2 decades. So 2001 start, 2021 end. So I'm looking at 20 years of data. I'm a long-term investor, so I will not take signals on the daily chart. I will look at weekly charts because I have personally seen that this signal works extremely well on longer time frames. So this is an analysis of the weekly chart of the Nifty over the last 20 years. All I'm saying is, the moment I get a long signal, I will go long the Nifty, either via mutual funds or whatever ETF, it can be anything. And once I go long, I will hold on to that long position for 13 weeks. इसके बीच में कुछ भी हो, from the time that I went long till the end of 13 weeks, उसके बीच में कुछ भी हो, I'm not going to care. I'm only going to look at what has happened to my position 13 weeks later. So let me run you through some of the most important numbers. Now, when I ran this analysis for the last 20 years, ending 2021, I can see that on the weekly chart of the Nifty, this event has occurred. This event has occurred 18 times. So 18 times in the last 20 years. And remember, we are not talking about short signals. We are only talking about long signals. So in the last 20 years, this has happened 18 times, which is what that total means. Now we'll talk about rise and fall. What does rise mean? And the number there is 12. Rise means in how many out of those 18 occasions was the Nifty trading at a higher value 13 weeks later? That number was 12. In 6 occasions, 13 weeks later, the Nifty was trading at a lower value compared to the value at which you bought the Nifty. That is what the numbers 12 and 6 mean, respectively. The most interesting aspect of that, though, is the average return or the mean return. If I had simply bought the Nifty on the basis of the Bollinger Bands outside-inside signal and held on to every long entry for 13 weeks, my average return would have been 4.43%, not including costs, which is great because the amount of transaction costs I'm going to incur is going to be a small amount because I'm not churning my portfolio every time there is an opportunity. I'm just buying and holding. So transaction costs are minimal. I'm not accounting for them anyways, but the average return would have been 4.43%. Now, if you ask me in the real world, this is a great amount of return because 20% हफ्ते का रिटर्न, 50% हफ्ते का रिटर्न या 100% हफ्ते का रिटर्न, ये सिर्फ ट्विटर पे ही पॉसिबल है, असली दुनिया में पॉसिबल नहीं है. So 4.43% over a 13-week period on the Nifty is very good. And we're not even talking about active management. We're just talking about buy and hold. If I increase the investing horizon or the holding period from 13 weeks to 26 weeks, the total number of events don't change. Signals तो उतने ही रहेंगे, 18 के 18. But now this number has jumped from 12 to 14, which means in 14 out of 18 cases, 26 weeks later, the Nifty was at a higher value compared to the value at which I bought. But that's not the important piece that I want you to focus on. The important piece is your average return jumps by almost 7 percentage points, which is really big. And if I go on further and increase my investing horizon from 26 weeks to 52 weeks, which is a full year, of course, the number of events in which the Nifty was higher 52 weeks out is again an improvement. We go from 14 to 15, but look at this jump. That's almost 8 percentage points. The average return jumps from 11.6% to 19.14%. A huge jump, if you ask me. Now, there are other numbers here which we will focus on in forthcoming sessions, but this is what investors of today are caring about. Let's say I'm the advisor. I run this analysis. I go to my investor who's always thinking long term, and I tell him that if you just do this, and I'm running a 20-year backtest. This is not like a 1-year backtest where the market has only gone up. over the last 20 years, several things have happened. The market's gone up very strongly. The market's gone down very strongly. The market's gone sideways for a long duration with no net direction. Everything has happened. So it's a long enough period. And if I were to tell him, here is a signal, here is a long entry that's occurred on the weekly chart as of this week. He's going to ask me, how has this worked in the past? If I tell him 15 out of 18 times, this particular strategy has generated a 12-month forward return of 20%, let me promise you, he will be super impressed. And he will have more confidence deploying a significant amount of his available capital into this strategy. And really, I mean, what was the strategy all about? Was this something, that was out of the blue? Was it something that was otherworldly? No, it's very simple. So that's the thing. Most people, who use the RSI, Bollinger Bands, don't really know how to use them in a way that professionals use them. That is where the real secret is. If you are only going to, master the RSI, if you're only going to spend time on the Bollinger Bands, make sure that you become an authority on the RSI and Bollinger Bands, which means even if John Bollinger comes to you and asks you about how you use Bollinger Bands, you should be able to confidently tell him, I use it in the way most people don't use it. That is where your alpha will come from. With that, I will close this session and invite questions from our participants. Thank you very much.
Hi guys, so if you all have questions, please post them in the questions tab or in the chat and mark them to panelists.
Please also remember, ladies and gentlemen, we will be sharing this deck with you, and I think this presentation has already been recorded.
Guys, once again, to repeat, there is a chat section and a question section that you will see. There'll be 2 panes. You can post any questions you have within those sections as well. Sajal, I have your question for the link of Go CMT Association. Are you referring to the Discord platform or to the CMT website? But either ways, what I'll do is I'll share it with Mayank and I'll ask him to circulate for both. The CMT, the Discord platform that Joel was talking about is the community where everyone gathers to discuss everything technical analysis. So Mayank, I'll share those links with you and feel free to please join that section.
Awesome, Kaizad. I believe we have no questions. So, I will, if anyone wants a copy of the deck, I'm happy to share it. The recording is already in place. And having said that, let us assemble once again in the coming weekend. Thank you everyone. Thank you, Mayank.
Thank you, Akshay.
Thank you everyone
for joining us. Bye bye.
Thank you so much.
Thank you guys. Bye bye.